Hi, I want to talk to you today about the idea of mortgages and how we can use them to create more financial security. So let's take a look at these two houses. Let's say this house is yours and this house is your neighbor's. Now, you both move into the houses and they're both worth $400,000, and when you move in you decide you're going to do a 30-year fixed for that full $400,000. Now your neighbor heard that you should do a down payment, so he does a 20% or $80,000 down payment. So his mortgage is on $320,000. Now his mortgage advisor talked to him and showed him that a 15-year mortgage, not only will you pay less interest per year, you'll also have it paid off quicker and pay a significantly less interest over the life of that mortgage. Now on yours, you wanted as low a payment as possible. So on that $400,000, you'd be paying around $2,000 a month. Now his mortgage, while it's a lower interest rate, it's actually a little bit higher payment. So he's going to be paying $2,400 a month for his mortgage. Now he saw that if you do an extra amount, he would have that paid off in 8 years if he does an extra $1,100 a month. So he makes it a nice round $3,500 each month that he's paying on his mortgage. Boom, he's going to be out of that thing in about 8 years. You choose just to do the minimum on yours, so you're doing the $2,000 a month. What happens over time, let's fast forward to 5 years later. Now on a 30-year fixed mortgage over the first 5 years, you don't pay down much. So you probably owe somewhere around $356,000 on your mortgage, whereas he is a few years away from having it completely paid off. He probably owes somewhere around $125,000 on his mortgage. Now, you're thinking, yeah, that's a great place to be, but let's say that both of you lose your jobs and neither one of you can make those mortgage payments anymore, not even the minimum. Which house is the bank going to foreclose on first? The one that owes them $356,000 or the one that owes them $125,000? The right answer is the one that owes them $125,000. Because when they sell this house, they're going to try to sell it quick. So they're going to sell it for maybe $350,000, $360,000. But then they also have to pay insurance, property maintenance on it. They have to pay taxes on the transaction. They also have to pay the realtors and the title companies when they close on it. So they're not even going to clear the $350,000 that this person owes. This one, they can sell real quick and recoup 100% of their money very fast. This one, they're a little more likely to work with and try to get some money out of that homeowner. Now, eventually, they're both going to get foreclosed on. But the question I have is, by paying down this house quickly, did your neighbor increase his financial security, or did he increase the bank's financial security? Well, the answer is he increased the bank's financial security. By paying down his house quickly, he's not increasing his livelihood, he's helping the bank. And that's part of why you get a lower interest rate on a 15-year mortgage than you do a 30-year mortgage, is because it's more secure for the bank. But let's say that you could have done this $3,500 a month, and instead of doing $3,500 a month like your neighbor is, you take that extra $1,500 each month and you just put it into cash, into something like a savings account. And let's say you did that over the 5 years. $1,500 a month over 1 year is about $18,000. $18,000 over 5 years, that'd be about $90,000 extra that you have in cash. Now, you also didn't do an $80,000 down payment, and you could have saved that in cash if you had it. So you're going to have $170,000 in cash 5 years later. And if you have that $170,000 in cash, you can make a lot of $2,000 a month payments until you get on your feet. And that's where having cash in your pocket is where we really get financial security from in life. Now let's look at a third example. So we're going to base it off this, but we're going to do a whole new example. This one, the first example here, is kind of worst case scenario. Let's play best case scenario. Let's say that you have in cash the full $400,000. Now, if we were to pay cash for that house, we would have the benefit of we wouldn't have to pay interest, because that's a loss on that house. And let's say the interest on that house in 1 year, let's say it's $20,000. Now you get a tax deduction. Now check with your tax advisor to make sure that's true for your family. But if you get a tax deduction of $5,000, that means our net loss from that interest is about $15,000. We don't like losing $15,000, so that would be the benefit of paying cash for that house. Let's say that someone chose to take the mortgage anyways because they really like having that $400,000 of financial security sitting in their pocket. They choose to lose this $15,000 down here, but let's say that we took the $400,000, put it in a savings account, maybe a money market or something like that, earning 3%. That means that year you're going to gain $12,000 in interest. Now the difference between the two is about $3,000. So that's a $3,000 loss to have access to $400,000. Is that a pretty cheap way to borrow money? Absolutely. Now let's take that a step further though, because over time the mortgage interest goes down with each and every payment. Whereas each year with compounding interest, this amount of interest goes up. If this goes up and this goes down, they cross at some point. And once they cross, not only do you have the $400,000 of financial security sitting in your pocket, you're actually earning more money than what you're paying out down here on the interest on your mortgage. And on a yearly basis, you're actually going to have more money because you took out the 30-year fixed mortgage and kept that cash and financial security there in your pocket. Thanks for listening today. If you have any other questions, reach out to us. We're always happy to help.